Coming up on 744, it's tax season. As you prepare your tax documents, get ready to file those 2022 taxes. You may want to consider some strategies that could save you upfront cost or save you money altogether, maybe down the road next year too. And for more on that, we're joined by Ernie Burns with Burns Estate Planning and Wealth Advisors. Good morning.
Good morning.
There are some things people can do so they don't have to pay upfront. 401ks come to mind.
Yeah, 401ks, but that was actually the end of last year. You can't contribute now.
Sure.
What you can do right now is you could contribute to your IRA or your Roth 401k possibly. So you just talk to your, your HR department and your CPA, but contributing to that simple IRA right now for 2022 will reduce your overall income for the level.
Which is a trick that people we mention that on our air once a year maybe.
Yeah.
This is the time, but there is a way to cut your obligation.
You could cut it for this year, and in addition to, you can do something about next year and future years down the road, depending on your age. You can contribute to a Roth conversion IRA. So if you are retired already and you're saying, hey, I want to lower my future taxes so my required minimum distributions won't get hit as hard. I won't get hit when I'm 73 now because the Secure Act 2.0 passed, so that's 73. Well, you can basically draw money out of your IRA and convert it to a Roth IRA, Roth conversions, and there's no income levels on that, and that will reduce your taxes in the future.
There are other, there are credits for electric cars, solar, all kinds of things that change. Some of those rules change each year, so it's important to stay on top of those.
Yes, and also, are you taking all the deductions you're allowed to take? Sit down with your CPA, or if you're getting a bad report, kind of like if you get a bad medical exam, you're told you need surgery, you want a second opinion, it's not bad to get a second opinion also on your taxes.
But on the other hand, the standard deduction now under the Trump tax plan that passed a few years ago is so high compared to what most people's itemized deductions are. I think I read 15% of people last year were still taking the mortgage deduction. So you really have to have a certain income level and expense to take advantage of that. Most people aren't going to do that, right?
That's true, but in the same instance, what you want to make sure is the tax brackets right now are 2 to 4% cheaper. We're at historical low tax brackets from 2018 prior. So now in 2026, the Trump tax cuts expire. So anything you can convert over to IRAs or retirement accounts that are Roths now, you basically are going to save 2 to 4%.
The Trump tax plan that we talked about, that sunsets, what, in 26?
Yeah, 26.
I was off by a year when we were in the commercial break, you reminded me. So is that something, Congress could act and change that, but that's something people have to plan for, isn't it?
Yes. If you have the right Congress in mind, I don't know if you can really plan for it, because you've got to basically plan what's in the laws now. But if they push that back, that'd be great. If they could keep the rates a little bit lower for a while longer, especially in a economy that's just trying to recover, right now, and still trying to recover from COVID and everything else that's happened with inflation, would be a win-win.
Somebody might push back and say there's a deficit issue there, but that's another subject, and we don't have time to go there.
Yeah.
But Ernie Burns, great stuff. Thank you as always.
Thank you.